Go back and look at gold over the last 50 years to give yourself some context. There have been three bull markets. One started in the early 1970s and ran to 1975 when gold was legalized here. Gold went from like $30 to $200. It was a 6-7-fold move. Then in 1976 to 1980, it went from $103 to $850, an 8-fold move. Okay. Then from 1999, it went from about $250 an ounce to $1,920 by 2011. It was a very long bull market, but an 8-fold move. Okay, so 3 times in 50 years, gold has produced basically a 7 or 8-fold move. So to argue just simply, based on what it's done before, almost routinely, we started from a low at 1,046, actually, intraday low back in December of 2015. We have only doubled since then. So you say, whoa, the big bull. No, it's minor compared to the 3 before. And look at the events that are surrounding gold right now. Monetary events, jeopardy of a lot of institutions that have basically taken the needle and put it in their arm for 12 years and had false investment and false assumptions about the cost of money, hence have made errors. The errors are being exposed. And once those errors get exposed and institutions start to collapse and certain assumptions start to be proven wrong, namely that the Fed is on the right, is the leader of things, then suddenly you have a cold water smashed in everybody's face. They realize that, good grief, we made a mistake. And I'm going to suspect, make you a bet, within the next 2 to 3 years, you will hear talk and possibly action about we don't need the central bank. Why not let money be priced by the free market like we do eggs or beef or grains or chips?
I don't think that could happen without a world war, though, do you?
Well, it could happen with an economic collapse and where people sit back and look at it. Already, you can see that some economists who are pro-Fed type economists and not anti-Fed, suddenly saying, hey, you guys have gone too far. Quit. Fed didn't quit, kept going for another couple of sessions, where some of these guys said, you've gone too far. You're going to create, well, sure enough, they get now look right. And they can stand up and say, we told you, Fed. So even some of the friends of the Fed have begun to inject doubt. And so it wouldn't shock me that the events create fracturing, a sense of, what did we do this for? It didn't work out. It's been 100 years of boom-bust cycles. Now we've created the biggest boom and now therefore the biggest bust in U.S. history with consequences attached to it. Now our argument's been that once these asset bubbles break, and municipal bonds, high yield corporate debt, stock prices, especially in the U.S.
And the dollar as the reserve currency also falling off?
And the dollar demise as well. Yeah, that will be the next wave effect that is probably right around the corner. Where suddenly you don't have any normal investment alternatives to go into. The 60-40 rule, 60% stocks, 40% bonds. Oh, you got a balanced portfolio, be in good shape. But last year you got killed with the 60-40. In fact, the bonds hurt you worse than the stock market did on a percentage loss, 21 to 22 close. So a lot of so-called truths and wisdoms have gone out the window. And a lot of asset managers and smart investors have said, hey, this doesn't work. What do I do? What do I do? Well, if you look at last year's action, and we used to post little simple graphs on year-to-date gains or losses in S&P, NASDAQ 100, muni bonds, et cetera. And you have these big negative bars on S&P and T bonds and so forth. And gold, 2021 close to the 2022 close, unchanged. 1820s. Silver, 2021 close to 2022 close, up 2 to 3%. Nobody realizes that, yet it was. Now, what did that say when all these orthodox portfolio components collapsed double-digit? No relief in the traditional portfolio components, and gold was unchanged. So even if you're not a gold bug, you're smacked in the face by that reality that, gee, I wish I'd been hiding in gold last year. And now this year, look what's going on. Gold's pushing back at the highs again. Silver's gone from a low near 17. It's now at 24 plus. Anyway, we think that the asset class shift into the monetary metals is underway because we think a monetary crisis has been exposed. It was created by the central banks. It's been punctured by the central bank policy. And once that balloon starts to implode, history shows that every time the Fed realizes shortly after a major bull market peak and you start to get downside in stocks and bonds or whatever, they start to shift rates back down again. But if you go back and look at the overlay of Fed funds chart, overlaid on an S&P, for example, you'll see that once those rates start to come back down, it doesn't help the stock market. It's too late. It helps it maybe a year or two later. But during the initial phase of when the Fed says, oh gosh, we were wrong, it doesn't help. That money goes somewhere else. And
Michael, is there a historical precedent that you're using to overlay the time that we live in now from an economics, financial standpoint?
No, I don't think there's anything comparable. And I beat the table on that. I mean, it's simple. 7-fold move in the S&P over a dozen years, 16-fold in NASDAQ. Find me a bull market peak that was that bloated during a boom-bust cycle, monetary boom-bust cycle. You can't find one. I mean, even the 29 high, I think, was like a triple. And when you go to the banks that can't fail, what the big 4 or 5, and look at the price charts, the S&P is well above the June and the October lows. So is NASDAQ. But Bank of America and Wells Fargo are below the June lows. So all of a sudden they look at one of the strongest components to where 2 of the big bank stocks are making new lows for the bear market. And Citicorp is not far behind. Citicorp's laying near the June lows and not far from its 2020 lows. So don't just look at the regionals and think, oh, it's just the regionals. Yeah, look at the big banks. Follow Bank of America, Wells Fargo, Citicorp, Goldman Sachs, etc. If you get even a rumor about a big bank, and we're hearing a lot of stories out there. There's been a lot of feed about some of these big brokers that also have banks. And some of them are well connected to big banks so that, if they ever had a problem, they'd be bought out by a big bank. So it's really not going to be a problem. But it's still something people weren't thinking about a couple months ago or even a month ago. Now suddenly they're ambushed by financial related declines. And things they didn't have to think about before, like, gee, I've got 400,000 in the bank account and that's over the 250 limit. I got to move some to another bank. God forbid you got 2 million, then you got to move it to 10 banks, or maybe you just make a phone call and buy some gold. And I suspect that that's crossed a lot of people's minds when they were having to make this switch to balance their insurance protection in their bank accounts. The thought about gold, something they haven't thought about in a long time. And, Americans have really lagged on that issue compared to foreigners in terms of the friendliness to gold. And so if the American market ever suddenly wakes up and wants to buy gold, well, gold and silver are pretty small markets, and the miners are definitely a small sector. So can you imagine what'll happen if there's a sudden shift to realization, gee, these things are behaving well. How come they're behaving well? They're not supposed to. The Fed's fighting, quote, inflation, which they narrowly define as commodity related. So we think, yes, commodities this time will be in sync with the current upturn in gold, which they weren't between 2015 and 2020. So commodities will be an arena, especially commodity-related stocks, because asset managers, they don't go out and buy corn futures usually, so they'll buy something related there too. So yes, I think that's a category to be focused on, and I think it will be in sync with gold. However, I don't think it will match the percentage gains you're going to see in gold and silver.
I'm a gold bug. And the reason I got into mining stocks is because I was buying physical gold and silver for so long. And then when silver got under $14 in 2015, I said, I got to make some leverage money off of the expected rise of silver. That's how I got into mining stocks. So I'm in your camp. But if I were to play devil's advocate and someone would say, well, I heard you say that, Michael, 2 years ago.
Yep.
How would you, because I think you even said it on this show that we're getting close.
I did. Yeah.
Okay.
And I could see the events coming, and they're still coming. I've not changed my macro fundamental or macro technical view. We turned bearish, for example, on T-bonds in late 2020, and they've collapsed since then. I think that collapse, by the way, is over. The stock market, we got bearish in January, February of last year, 2 months off the high, arguing that the downturn isn't a correction. It's the beginning of a major bear market, the deflation of a massive bubble. We still hold with that. But during that time, silver and gold had gone up, doubled, basically. Okay, gold had definitely doubled to 1,050 in 2015. By mid-2020, they doubled. Okay. Meanwhile, commodities had gone down during that time. So gold and silver went up on their own due to monetary factors. But then they went into this, what for gold turned out to be really, when you stand back and look at it, a congestion zone between the high 1600s and above 2000. Briefly pierced the bottom of that as a bear trap, hooked right back up to the top of the range now. Silver during that time had a corrective process, which was much longer lasting than we thought it might be. But we still defined it as not a bear market, but a corrective process when you look at the longer term trend. We think that's now over, the corrective process. We think we're now in the early phase of the resumption of what is, in fact, a bull market that began from 2015 lows.